No mercy for the debt sheep sent to the slaughter. Martin North, John Adams, in the interest of people. John, what a title.
What a title. But very important show today. A lot of people caught short with the RBA's increase in the official cash rate by 0.5%. So now they took it to 0.85. And I think in the 24 hours prior to the decision, I did a poll on Twitter, and the bulk of the people in the poll thought it was only going to be 0.25. So now I thought 0.4, because I thought they would go to a nice 0.75, but they went the full 0.5%. And that obviously has a big impact. And that impact, Martin, is basically the second decision in 4 weeks. So we think the first Tuesday of May, now we've just gone past the first Tuesday of June, 4 weeks, 2 decisions. And now we've got another 4 weeks on the 5th of July, where there'll be another decision as well. And within the space of literally 8 calendar weeks, it's going to be a dramatic impact for a lot of households across the country. And it's going to be very interesting to see what happens in terms of all the issues that we've been discussing for all over the years. I mean, so we've been warning as early as 2018 to get your debt under control. Don't follow the mainstream media. Don't buy into the whole property bubble mania. You and I practice what we preach. We have no debt, so we're sort of sitting on this at the sidelines, just waiting and seeing how the economy is going to unfold. And like we said in the last show, the RBA are making now these dramatic decisions, and they say, even as late as yesterday, saying we don't have the full understanding of what the impact will be. And whereas before they said more of a macro statement, we don't know exactly how the impact is going to be. What they said yesterday was specifically household consumption. So this whole bubble circles around households and household debt tied to property, and the one most sensitive aspect of the economy. The RBA said yesterday, we're raising these rates and we're going to put a knife in the heart of the bubble, and we don't know exactly how it's going to play out. So we're walking into the abyss. This is what they call data dependency. We're going to see how the data unfolds, but obviously one of the interesting aspects of this, Martin, is because they are making decisions in a relatively quick fashion, you're not going to get data to really assess the impact before it's potentially too late for certain people. So unfortunately, there will be, in this aggressive interest rate tightening campaign, there will be a certain number of households that will go bankrupt in the process. And just like we said in the last show, the elite don't care about these people. So there could be 3, 4, 5% of households, they'll say, fine, default, or we're going to really slam you in terms of your financial situation. All that the elite are worried about is ensuring that the financial system, i.e. the banks, don't go bankrupt. But there will be a whole host of people who bought into the mainstream narrative, signed contracts that they should never have signed because they were just astronomical sums of debt, and now they're going to be sort of sent to the slaughter. And now you and I are going to portion some blame on some of these elite institutions today, but ultimately, the government and the RBA and all these people and the mainstream media who encourage everyone to basically get into the property market at these exorbitant sums, they're ultimately going to call caveat emptor and say, no one put a gun to your head to sign the contract. You sign the contract, so it's on you. And unfortunately, for a set of households across the country, it's going to, again, so once you go through this devastating process of being forced to sell or potentially going through a mortgage in repossession situation, the impact on your financial life could really set you back years.
Yeah, it is worrying, of course, but I would make the point, John, that I measure financial stress, so flow stress, right? A lot of people prioritize their mortgage repayments over pretty much everything else, right? So I'm already seeing in my data some people giving up on dental treatment, for example, and pulling their kids out of private school and putting them into the public system instead, simply because they're trying to get by. The trouble is, of course, that if rates go on going up, this is a huge acceleration in terms of drain on the finances. And the question is, how long will people be able to survive? And the buffers that everybody keeps talking about, and I get very frustrated about this, the buffers are not equally spread across all households.
Yes.
We've got a bunch of households that are fine. They've got plenty of buffers. They're well paid ahead, no issues. We've got other households that really have nothing at all. They're hand to mouth, paycheck to paycheck. And now you've got this impulse of inflation and higher debt as well. So it's a very concerning situation.
One of the interesting stories that you told me about yesterday, Martin, was about some of your local conversations here in Wollongong. And one of the things I think you said to me off camera was that some of the agents have said that the bottom has already fallen out of the market, and that if you want to get a sale in Wollongong, the current price will not sell. You've got to at least cut 10%.
Yep.
And that was 10% before yesterday.
Yep.
So now that we've had yesterday's decision, who knows, maybe if you want to sell in Wollongong, you have to cut 15, 20%. And that's going to be a huge fall for a lot of people who bought at the top of the market.
Well, it depends. Some properties with views, and particularly if they're houses with sea views, they'll probably hold their value a bit better. But your bog standard, less good property, or indeed some of the apartments, of which there are many being built still down in Wollongong and the surrounding area, they're already seeing massive falls. And I would remind you, I keep coming back to this, but North Ryde apartments, right? They hit their peak price in 2017. They never recovered through the last 4 or 5 years. Just a very important object lesson: prices don't always go up.
Yes. Now, when we think about so if we're starting to say we're seeing the beginnings of a deflationary cycle, now the key point on this, Martin, is that we are starting to see deflation in the sense of the property market, although as a broader economy we still have a stagflation sort of situation. Even the World Bank is raising the alarm bell about stagflation. But how does this process actually work? Now, I've done some, I remember doing a presentation about this back in 2019, but basically in a bubble, you have a whole bunch of, you have a misallocation of resources in the economy. You have a whole bunch of labor, capital, entrepreneurs' land being pushed into a segment that shouldn't get the amount of resources that they have. And so once you start to unravel that bubble, those sectors that are tied up in the bubble, they're the ones that they feel the pain the first. So which are the key sectors which are tied to this household debt bubble, property bubble? It's the finance sector. So banks and mortgage brokers. It's real estate sector, real estate agents, etc., auctioneers. You've got the construction sector, and then you have the retail sector and the service sector. So we've had a whole bunch of growth in types of these businesses, and the number of people being working in these sectors, the level of incomes that they have been earning have been quite high compared to other sectors in the economy, and there's obviously a lot of jobs. So as the rates start to go up and as the economy starts to unravel, well, it's these sectors where you're going to start to see some of the pain the first. So the pain won't be uniform across the industry, across the economy. It's in particular segments that are particularly tied to the bubble. And even if we just put up slide 4, Martin, there was just an article in the AFI that I saw today that the property companies listed on the Australian Stock Exchange are already down 20%. So you're already starting to see a whole bunch of companies tied to building properties or property management. They're all starting to fall in value because they're expecting that their business profits are going to reduce as well. So now it's important to note that part of the reason for raising rates is because of supposedly robust economic growth and record low unemployment. Now, unemployment is always a lag factor. So now, even before you get people unemployed, what's going to happen, well, what's probably already happening now as we go forward, is people's income are going to fall. So business profits will go down. There'll be people being asked to take pay cuts, and those pay cuts, even if you don't lose your job, is enough to really tip you into a financial stress situation. So if you've got inflation, if you've got rising interest rates on a big debt, and if you've got your income being compromised, that puts you in a very difficult situation. So, if people say, well, we're going to wait for unemployment to go sky high, things can start to get really nasty even before you get unemployment. And one of the classic things that I think Eddie Hobbs told us back in 2019 about Ireland, well, who are the ones that typically get into the most debt? Real estate agents, in terms of bank employees, construction workers, because these people who work in the bubble tend to believe the propaganda the most. And then they go over commit. When things start to unravel, it's these types of employees that actually get into the trouble the first, but also the most.
Yeah, I agree. And I'll make the one point. I don't think the retail sector's done at all well over the last 2 or 3 years. I wouldn't put them in the same category as the financial sector. And a lot of small retailers are sitting on these lock-up shops. They've had leases parked at the moment at a certain level, but those are all going to unwind now. A lot of those retail people are going to actually fall over too. And I actually think the retail sector and the commercial property sector is worth watching, because I think that's where we will see some of the early cracks. I actually think in my SME surveys I'm already seeing some of that. So I'm watching that very closely. But I make the point, a lot of those retailers have mortgages on their existing property, the residential property, to fund their business. And so this linkage between the SME business and its commercial operation and the mortgage on the property is another nexus that needs to be understood. And again, I don't think many people really understood the connections between the two.
As people prioritise payment of the mortgage, discretionary spending is going to fall.
Absolutely.
So even if they were struggling the last couple of years, their ability to generate income going forward is going to go down dramatically.
That's it. Well, I think we're exactly on the same page, John, and that's my point really, that I think we should be watching some of those industry sectors, because I think that the issue there is already pretty far gone. And remember the other point we made the other day, that the ATO is now starting to demand payment of outstanding debts?
Yes.
Great timing.
Yes, indeed. Now the thing is that so we are on track. Now again, don't want to be too alarmist, but if the RBA continued on this path and they said we're not going to stop, where's the ultimate destination? It's Ireland. And Ireland's a better measure for us compared to the United States. And we've said this over the last few years, because what happened in Ireland was that middle to upper income people held most of the debt, whereas before the GFC, poor people with these subprime loans held a lot of the debt. So our debt distribution profile in Australia today is very similar to what happened in Ireland. Yep. And I would say with all these factors that you've just outlined, the situation perhaps in Australia is perhaps more dire and nasty and potentially more volatile than what Ireland was facing in, say, 2006, 2007. So if we were to, if Philip Lowe said we're going to go all the way, we're going to raise rates and we're not going to stop, it will be Ireland. Now, at some point, and this is the whole thesis of the last few weeks, they don't want Ireland to happen, because it means that the banks will go bust. And so at some point they're going to stop. But what we don't know is when that will be. Yep. And how much pain will be inflicted. But just to give you a sense as to what were the early warning signals in Ireland and what we could be expecting here in Australia. So let's put slide 5 up. So these are some things that I remember Eddie Hobbs telling me back a number of years ago. These were the early signs in Ireland of the crash happening. So falling credit growth. Now, you've talked about credit growth plateauing, yep. So we're going to start to see it to fall. Falling property prices, well, again, that has started. Poor sales of new property, well, we're seeing a listings glut, so sales are going to start to fall. Falling discretionary consumption, we've already talked about that. Forced credit reviews. You've even said in the last couple of days that people are starting to get tapped on the shoulder by the banks and saying it's time to sell. Increased household savings. I mean, that probably hasn't happened yet. So that's a bit of a delayed phenomena as rates start to go up.
The savings housing ratio is falling now.
Yes.
Right? It was very high. It's been falling. A lot of people have been raiding their savings just to get through already.
Yes. So the other one is difficulty of paying school fees. You've talked about that. People are now contemplating switching their children from private school to public school. The dropping of health insurance, where you talked about people are foregoing dental services, yep. And then reduced cafe and in terms of restaurant traffic, etc. So some of these signs we're starting to see. these signs that happen in Ireland will intensify here in Australia. And the question will become is, at what point will the alarm bells go off and say we can't go beyond that? Now, at that point in which they say stop or we're going to do pause, whether it's here or the UK or the US, that's when you're going to have a dramatic reversal in the fortunes of various financial markets. But in terms of those who are worried, the short-term impact, it's going to be slaughter for a certain percentage of households. The question is how many? And the question is, have you set yourself up that you can get through this period okay? And if you're in some trouble, what's the best decisions that you can make over the next 6 months that can give you the best chance of minimizing any potential financial harm that you may experience? But unfortunately, just to go to the top of the premise of the show, is a whole bunch of people swallow the propaganda, sign mortgages that they shouldn't have signed, didn't do proper due diligence, and now the chickens are coming home to roost, and the elite are going to basically adversely impact thousands of people across the country. And at the end of the day, they don't care, because it's caveat emptor, and they say, you made the choice, it's your decision, and we're just going to get off scot-free.
Yeah, unfortunately that is. No accountability. I mean, two points though. One is people can still do things, get a cash flow, understand where your money's going, start prioritising now. And the second is there are still people who are locked into higher rate mortgages than they need to. So go shop around, use the portals to find the best rates, because you can still get better rates. And if you can save 25 basis points by switching, that will save a bit of money too. So there are things that people can do, but it's not going to be enough.
Yes.
A lot of people are going to get caught, but they're caught because of many years of, propaganda, frankly. People swallowed it, and now, unfortunately, as you say, chickens coming home to roost, and sheep being taken to the slaughter.